This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And U.S. stock markets did not like it today as we came back from the Easter holiday weekend in Europe. It seemed like money was pouring out of U.S. equity markets and going elsewhere. But it is not going to be the U.S. that will be the biggest loser from rate cuts, it would seem, because the story is not, of course, just a U.S. story. Inflation has been an issue globally after COVID. All the major central banks have been fighting it. And the biggest loser from this normalization process looks like it's not going to be in the U.S. at all. Instead, what we are looking at here is something else entirely. And that's what we're going to spend some time today talking about, because indeed, what we are getting in parallel with our conversations about the Fed, our conversations about what that means for stock markets and interest rates, is a conversation about currencies and the relative strength of those currencies as different central banks approach their own inflation issues. And of course, almost all of them have seen a significant interest rate hike cycle. And almost all of them have signaled that that interest rate hike cycle has ended late last year. And almost all of them are now eyeing rate cuts. And the biggest loser from those rate cuts certainly doesn't look to be the US dollar. Now, we're going to get a bit of a piece in this story here in the coming 2 days as we get inflation data updated from the euro area, just at a time when we'll talk about the specific price levels at the end here, but just when the euro is sitting squarely at a critical level against the dollar, where if this level breaks, the subsequent move could be very sharp indeed. And this data that we're going to be looking at here might well be the catalyst that gets us there. So, what is it that's on the menu? Here we have the expectations for German inflation data coming out over the next 24 hours and regional-wide Eurozone data that follows the next day. Now, the region-wide number you can see here looks innocuous enough. 2.6% was the number for March. 2.6% looks like it's going to be the baseline expectation for this next release. Or rather, 2.6 was February, and it looks like 2.6 is going to be in March again. But that kind of averaging hides what is a much more significant move toward disinflation. Note what's going on here on German numbers, and I'm focused on the harmonized inflation rate because that's the one that matters most for the ECB. These numbers use a Germany-specific methodology. This one uses the same methodology as is used by the ECB, and so this is the one that factors most critically into monetary policy. And you can see here, we're looking for inflation to come down from 2.7 to 2.4%. If you look at the core rate for the region, you're looking to come down from 3.1 to 3%. And these are important thresholds. For Germany, just to put this in context, 2.4% would be the lowest since November of 2023. For the region, 3% for the core, which excludes energy and food, which are volatile and can shade things, would be a 2-year low. So the progress on disinflation really seems to be afoot in the Eurozone. And if we look at the breakdown of what has made inflation sticky on the upside, both last year the year before and how those things have developed now, the progress that we've seen appears to be broadening. So note here, of course, in early 2022, this was a story mainly about energy. This is the housing, water, electricity, and gas section. And of course, gas, in particular, natural gas, is the biggest story here. We, of course, had Russia's invasion of Ukraine at the beginning of 2022, concerns about the energy supply disruption there for the Eurozone, a bunch of subsidies introduced on that basis. And so clearly a very significant jump in the contribution of energy to the overall CPI mix, as it turned out that there was really no supply disruption. That influence faded and, in fact, was actually a deflationary force into the late part of last year as some of those subsidy base effects were worked off. Now we can see that's mostly down to nothing as a contribution. And when we look at the next kind of big part of this, it was the global rise in food costs. So food inflation was a really big part of this story last year. What we find when we look at the most recent movements here is that all of this has increasingly worked its way down, and we are looking at a much more equally weighted inflation here that suggests that the ECB is really well on its way to getting to where it needs to go. In fact, if we look at the breakdown in the components here, what we find is food, of course, is still a leader, but compared to where it was, it has moved in significantly. So this is the January reading here. This is February. It's gone from 88 percentage points in its contribution to the overall total to only 54. And that's actually the smallest contribution from food inflation to overall inflation since November of 2021. Whereas last year, food was easily the biggest uplift on overall CPI by a long mile, too. So we're looking at a situation where these concerns have come in significantly. Moreover, they're likely to continue to come in. As we look at the relationship here between global food prices, this is data from the United Nations, the Food and Ag Organization within the United Nations, FAO. What we see here, they put together a price index of global food prices, a kind of basket. That's the lighter line there. You can see that Eurozone CPI lags that by about 7 months. So there's about a 7-month transmission mechanism where global food prices do something. Of course, the ECB has very little agency here. They can't exactly set interest rates such that people don't need to eat. So clearly, there's not a whole lot they can do here with monetary policy. It's largely a function of global dynamics. But what you see here is it takes about 7 months from whatever happens to global food costs to make its way into overall CPI. And so what you find is that we have here still a significant tail left in the pipeline. There is more of this downside influence that's coming. To put it another way, this push down in the purple food cost inflation component of CPI, that's likely to continue, because what we can clearly see here is there is more to do that hasn't made its way into CPI just yet. The other major component here is hospitality, which is very clearly on the discretionary spending side of things, restaurants and hotels. In fact, that's now the biggest contributor to overall CPI, and it's holding fairly steady. It's narrowly edged out food at this point. And here the question is primarily of labor, but of course, this is also a discretionary spending area. And so as you get economic weakness, you would expect less money to go toward things that are inherently optional and return to brass tacks. And so you might expect to see this component deflating just because of the economic cycle. And indeed, if we look at the latest PMI numbers out of the Eurozone, we find that you have the 9th consecutive month of shrinking economic activity in March. Now, it's very narrow. 49.9 is almost at that middle line of 50. That's the point for the PMI data where there is neither growth nor contraction. Above 50 is growth. That's what we see for services, accelerating higher a little bit here at 51.1. But of course, that's offset by deteriorating manufacturing. So there was some attempt at getting manufacturing off the ground here. It's still, you can see, woefully under 50, so still very much in contraction territory, and has been here since essentially the middle of 2022. But the pace of contraction seemed to ease a bit and then start to deteriorate again. So when you look at this together, that's evened out to about standstill for the economy, narrowly below 50, so narrowly a contraction for the 9th consecutive month. But clearly, this is not an economy that's doing well. This is an economy that's barely squeaking by near neutral. Not exactly the kind of an economy that's growing. And of course, when we've had so much contraction already, basically from the middle of last year through to the beginning of this one, you need growth to accelerate in order to make up lost ground. That's not what's going on here. We're barely struggling to stand still with all of the losses to economic activity that we've already seen baked into the pot. So this is a very weak economy, clearly, and discretionary spending looks likely to suffer in that kind of a scenario. So the case for continued disinflation looks encouraging here. In fact, if we look at what the markets are pricing in at this point, this is the 2-year German break-even rate. It's the difference between nominal and real interest rates at the 2-year tenor in Germany, so essentially near-term rates. And when you take the difference between nominal and real, you get to extract from that differential the inflation adjustment the bond market is pricing in to get you from nominal to real, right? Because nominal is real plus or minus whatever inflation coefficient. And what we see here is that the inflation coefficient has arrived at essentially exactly the ECB target. We're sitting right at, or just below here, the 2% mark. And so what we see then is all of the argument that one could really imagine is needed for the ECB to make a move. And indeed, the markets anticipate as much. If we look at what is being priced in currently, it is, of course, following the trend toward reducing some of the excess in rate cut expectations from the start of the year. We were looking for 6 cuts as 2024 got underway. It looks like now we're leaning in the direction of 4. So 75 basis points or 3 cuts are all the way baked in. And then when we look at the likelihood for a 4th, so 87 basis points is obviously greater than 75, that gives us about a 47, 48% chance for a 4th cut before year end. And if we look at the way that this lines up relatively to ECB meetings, there looks like a commanding chance that the first cut is coming in June. So you can see here we're but 2 basis points off. That's essentially a rounding error. So the first cut overwhelmingly likely at this point in June. And then the second one is already there by September. So it occurs somewhere at either the July or the September meeting. And then we very quickly get to almost 4 by year end. So we're just 4 basis points off from 4 by the end of the year. Of course, 4 cuts or exactly 1% or 100 basis points would be a move from 3 to exactly 4. And since, or from 4 to exactly 3, rather. And since we're just above 3, we're not quite priced in for 4, but almost all the way there. Now, this already is putting the euro at a significant disadvantage, because if we look at where interest rates for the major central banks are expected to end up by year end, the peak is expected to be the lowest for the eurozone. So this is a chart of where interest rates are going to be by the end of the year for the major economies, where we have liquid futures to make something of a forecast. And you can see here at this point, the US has moved to having the highest rates of the bunch. After that, the Bank of England, then the Bank of Canada, then the RBA, the Reserve Bank of Australia, and way down here is the ECB. So a significant yield disadvantage is already on the cards here. Now, if you consider then what happens next, the question becomes, what does the CPI data mean? Is it going to necessarily give us a situation where this ranking is going to change? Probably not. But what it might do is change the timing component. So if we're here and we're looking for the first cut in June, and we're starting to price it in for April, but it's only about a 44-45% chance for this month, if you got soft data, that might shift. And the markets might think, well, it's not that the cuts are going to be necessarily more, it's that maybe we get to fully price in the 4, and maybe the first one then occurs as soon as this month, as far as expectations go. And as it happens, if we look at the Citigroup Economic Surprise Index for the Eurozone, we can see that there's been narrow improvement in economic data from about the middle of last year. Incidentally, the PMIs bear that out. Notice this is now July, August, and we can see that there's a slight improvement here. We're still below the zero line, but a slight improvement nevertheless. And if we look at the PMIs, we can see, well, here we go. This is that same improvement right here. And so when you look at the most recent numbers, what is, of course, immediately striking is that this index has stopped improving and now is starting to fade a bit, which sets the stage for the possibility that we could get a lower than expected set of numbers, and indeed shift us into the likelihood of an April cut being greater and into the 4 cuts being all the way baked in by year end. Now, of course, that's not going to sit well with the euro, which tellingly has already taken out support at the 108 figure. You can see here it attempted to retest it today and failed to make it to the other side. So this looks like a correction today in a move that is otherwise pointed squarely lower. Next layer of support here looks to be down here in the 107.28, 107.10, basically right around the 107 figure. If we can get enough momentum out of the CPI data to break that, there is a whole lot of air down here. And maybe you get a bit of a stop at the 106 figure toward the middle of this congestion, but there seems relatively little that stands in the way once you take out 107 from testing below 105. So we could get some very significant selling if this follows through, and weak CPI data would go a long way to getting us there. Now, of course, we also have a speech from Fed Chair Powell, who is unlikely to say anything meaningfully less hawkish than he said mere days ago. He just spoke on Friday. And also more U.S. economic data, which, unlike in the Eurozone, has tended to surprise on the upside. All of that adding to the possibility that you get a potent amount of fuel for a break. And of course, if that break occurs, then gravity might well take over from there. Now, if in fact we do make it back over and find ourselves back in this area here, there is the possibility that you could retest into the 109 area. But at this stage, here was a trend higher. It's been broken. The sequence since then has been of lower highs. And what we're looking for now is a lower low to extend this move to what is the next leg of the decline. And that is macro money for today. As ever, we are after overtime here, Monday through Thursday. I'm also on with Chris for Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.